Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Stephen Message, manager of the Old Mutual UK Equity Income Fund, to give his 3 stock picks. Hi Stephen.
Hi there.
So what's the first company you'd like to highlight today? So
the first company I'd like to highlight is Vodafone, mobile telecoms operator, principally in Europe these days. What the business did, it sold the majority of its stake in Verizon Wireless, US business, and it's used the proceeds, part of the proceeds from that sale, to reinvest into its European markets to ultimately improve levels of customer service, to improve network levels, to ultimately drive a better performance for its customers. And you should then hopefully then see the performance of the business improving. The big trend which is going on in mobile telecommunications at the moment is the adoption of 4G services and data services, and typically when you move from 3G to 4G, your data usage typically doubles. And Vodafone is really seeing a quite significant benefit from that, because ultimately it can start to charge more for its product. So it's invested in its product, starting to charge more for it, which ultimately means it's got pricing power. Pricing power is a thing we haven't seen in telecoms for quite some time, and if ultimately you can start putting your prices up, then as an income investor, the dividends to me start to grow quite nicely as well. So everything's starting to move in the right direction for Vodafone. A dividend yield of 5% today, with finally some potential to grow that dividend as those cash flows improve, supported by the better prices, makes quite a compelling investment case over the next few years. Now, there has been quite a lot of consolidation within the mobile telecoms industry across Europe. We've had a deal recently not being allowed between EE and O2. But that is the way that things are moving. We're moving towards a sort of 3-player market. Is that going to affect Vodafone? Yes, so the regulatory stance has moved around a bit. For Vodafone, one of the key positives was in Germany, which is one of their largest markets. We did see a merger from 4 to 3 operators, which ultimately consolidation means you should get a more disciplined, competitive environment, should lead to more sensible pricing. But actually it's gone slightly the other way, for example, in the UK at the moment, which suggests we're not fully there. So when I'm thinking about Vodafone from here, there's a proposal for a merger in Italy, for example, where Vodafone operates. We're going to 4 to 3. That hasn't happened yet. The regulatory stance is still a bit of a risk for the company, but ultimately I'm quite pleased, for example, in Germany that has come through, and you're starting to see the benefit of that in Vodafone's numbers. And what's the second stock today? So the second stock I'd like to highlight would be Lloyds Bank, domestic retail bank. It's got a large share in the mortgage market, around 20%. It's gone quite a journey over the past few years, especially as an income investor. It didn't pay dividends for a number of years. It was absent from the dividend register for about 6.5 years. It returned to the dividend register last year, and a few months ago we saw the dividend step up slightly. In fact, we got a special dividend. So we've gone from a scenario where a business hadn't paid a dividend for quite some time. They've returned to the dividend register, and we're at a point now where the capital position is a lot better for the company, much more adequately capitalised. They're paying dividends. In my view, the regulatory stance, we had the Bank of England passing the Bank of England stress test for that business as well, suggests to me that the scope for dividend payments going forward can be quite meaningful at Lloyds, to the point where we think that the shares could be yielding anywhere up to 6 or 7 or 8% over the next few years, as those returns and the balance sheet is in a lot better shape. They've taken their punishment and they've come out the other side. Absolutely, absolutely. And it's gone from a point where I think a number of investors haven't really looked at it for quite some time because it hadn't been paying a dividend. But these dividends, in their absolute sense, and the magnitude of dividends, they're meaningful dividends. We're talking north of £1 billion worth of dividends. So I think a lot of people will start looking at Lloyds again, and I'm very happy for it to become a boring retail high street bank going forward, where the dividend payment should be quite attractive and growing. And what's the third and final stock? So the third one I'd like to highlight is a mid-cap company. This is a company called SSP Group. It came to the market a couple of years ago. It's one of the IPOs that we did support. The interesting thing with this company is it's been run by a manager with a good track record of delivering within the travel market, Kate Swan, who worked at WH Smith, growing the travel franchise there. And we think the operating margins at SSP can really start to improve as they focus on some of the key metrics within the business, so reducing waste, looking at better levels of staff resourcing, for example, just doing procurement a lot better than it had done in the past. If you put all these things together, you can build a scenario where the margins, low single digits at the moment, can grow quite nicely over the next few years. And similarly with the case talking about Vodafone earlier on, that should mean the scope for dividend growth is quite strong. Stephen, thank you very much. Thank you. This is Emma Wall for Morningstar. Thank you for watching.